Starbucks just released their latest quarter's earnings report, and over the past year, this is a stock that's been absolutely hammered. They're down over 25%, and they're pretty close to their 52-week low of around $71.55. Now, we can see the company as of right now trading at $75.94, but after hours, they're up about 2.25%. So in this video, we're going to be analyzing the recent earnings report, be looking at some key metrics for the company, and like always, seeing if we can calculate the intrinsic value. So let's go ahead and start jumping in. Now, leading up to this earnings report, expectations were not very high. If we look at the expectations, we can see in the last 90 days, there were 27 downward revisions for estimates and 0 upward revisions. So obviously people are pretty bearish on this company right now, and it's not really a surprise. When you look at how the company performed last quarter, it was one of their worst earnings reports in a very long time, and this is exactly what pushed the share price down so much in just a single trading day. They went from around $88 per share all the way down to around $72 to $73 per share. So that was a massive one-day drop. Now, if we go ahead and look at the results for Starbucks, we'll scroll down, we can see Q3 non-GAAP earnings per share came in at 93 cents, which was in line with analyst expectations, but they still saw a slight miss on revenue. Revenue came in at about $9.1 billion, which was down about 1% year over year, but this was a miss by around $150 million. Now, we can dig into this a little bit more by looking at the earnings released from Starbucks, and there's definitely some key things that you need to know that I'm going to go ahead and point out. If we go ahead and slide down, one of the things we can see at the end of Q3 right here, stores in the US and China comprise 61% of the company's global portfolio. So US and China, by far the largest markets for Starbucks, with 16,730 stores in America and 7,306 in China as of right now. There is plenty of bad that we're going to talk about here in just a moment, but I do want to point out one of the good things that I think should have investors excited. We can see Starbucks Rewards loyalty program 90-day active members in the US totaled 33.8 million, which is up 7% year over year. I think this is a big deal for the company. The loyalty program for Starbucks has proven to be something that consistently gets their customers back in their stores. Now, let me show you why that's a big deal. If we keep scrolling down right here, we can see Q3 North America segment results. We can see change in comparable store sales was down 2% compared to Q3 in 2023 when it was up 7%. So that's a pretty big difference, but here's what's really interesting. Change in transactions. Transactions were down 6% year over year. This means they're seeing less customers in their store. And I think the hope is that the loyalty rewards program will start to get some of their usual customer base back in their stores. Now, on the bright side, we can see change in ticket, up 3%. This basically means customers are spending more for each transaction that is going on. And then finally, what I want to point out is operating margin. This was 21%, and compared to last year, it was sitting at 21.7%. But here's why I partially think the market is responding well to this earnings report. Again, we can see after hours, they're now up 4.29%, so it looks like they're jumping. But if we go over and look at the Q2 earnings report, if I scroll down, we can see last quarter, operating margin was actually about 18%. So it's taken a pretty big jump up compared to where they were last quarter. Now, the same was true in 2023 as well. We can see Q3 of 2023, 21.7%, and Q2 of 2023, 19.1%. So we did see this in both quarters, but still, it's a good sign to see that overall. Now, if we scroll down, we can see how the company is performing in international markets. And again, this is where things really look rough for the company. Starbucks, again, they have big plans to continue to expand in China, but right now this doesn't look like the best use of their capital. Now, long term, this still could be a good move, but there's no doubt international markets are hurting the company right now. We can see change in comparable store sales down significantly, 7%, change in transactions down 3%, and even change in ticket prices down 4%. And some of this comes after Starbucks has lowered some of its prices in the China markets because they're just not seeing enough transactions. They're not seeing enough foot traffic. So this was one of their strategies, lowering some of the prices of their goods. But again, this is definitely hurting the bottom line, as we can see operating margin now sitting at 15.6% when last year sitting at about 19%. That's a pretty massive difference, and it's going to make a big difference in the bottom line for this company. Now, again, if we look at the Q2 results for the company, we can see operating margins in international markets was 13.3%. So again, quarter over quarter, we did see some growth, but that was pretty standard the previous year as well. Now, to be fair, I think some of the poor results aren't necessarily a result of Starbucks doing something wrong, but if we scroll down, I'm actually going to agree with one of the comments from their management team. We can see our efficiency efforts, which are tracked ahead of expectations, partially offset investments associated with the cautious consumer environment. That's the key statement right there. I think any company like Starbucks, whether it's something like McDonald's, would say that the market right now has a cautious consumer environment. We're seeing this over and over again. For example, McDonald's, they reported earnings just the other day as well, and it really wasn't the best results. Inflation has definitely caused items to be quite a bit more expensive, and consumers are showing they don't want to pay those more expensive prices. So some of it does have to do with the market as a whole. Now, if we jump over to our balance sheet, there is something else that I want to point out. I'll come up here, plug in SBUX, and hit enter. and you can see all this data will automatically load in. And again, like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets, it allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, overall, again, I think Starbucks does have some signs that they're a quality company, but right now the balance sheet isn't looking its best. We're looking at data as of the end of 2023, and we can see total current liabilities actually was larger than total current assets, which gave them a current ratio of just 0.78. Typically, you want to see this at least above 1. And then we can see the debt to assets ratio sitting at about 83.54%. Now, that's not the end of the world, but ideally I would like to see this a little bit healthier, to be honest. And again, keep in mind, debt to assets ratio is simply your total debt divided by total assets. Now, if we look at the company from a dividend perspective, we'll plug in SBUX. We can see as of right now, the company has a starting dividend yield sitting right at 3%. Now, here's why this is interesting. If we jump back over to Seeking Alpha, click on dividends and look at the dividend yield history for this company, we can see historically speaking, for most of the past 5 years, it looks like all of the last 5 years, they haven't had a starting dividend yield as high as 3%. This is the highest starting dividend yield in 5 years. And if we zoom out 10 years, we can see the highest starting dividend yield in over 10 years now. So you're getting a really nice starting dividend yield compared to the company's historical starting dividend yield. And when you combine that with the pretty solid dividend growth they've seen, we have 10-year dividend CAGR of 15.28, 5-year dividend CAGR of 8.88%. Looks like a pretty good combination from a dividend perspective. We can see the dividend payout right now sitting at $2.28, and the dividend growth chart looks pretty solid, going from around 45 cents per share in 2013 up to $2.16 in 2023, and now $2.28. Now, something I don't necessarily like about Starbucks. Free cash flow has been kind of all over the place. Now, this isn't always the end of the world, but personally, I like to have some predictability and some stability in the free cash flow of the companies that I buy. And the reason behind this is, again, I'm a dividend growth investor. I want to buy stocks that are constantly increasing their dividend payouts over time. And the easiest way for me to be able to tell if a company is going to be able to continue to grow its dividend payments over time is if I can see very predictable, stable free cash flow growth. Now, again, they have done a good job of growing those dividend payments, but I want to see some more stable free cash flow. This is something I don't really like about Starbucks. Now, in other recent news surrounding Starbucks, we can see Elliott Management take sizable stake in Starbucks. Now, why is this a big deal? Well, this actually moved markets quite a bit more than you would expect. In fact, if we look at Starbucks over the past month, we'll go back over to Seeking Alpha. We can see over the past month, been quite a bit of volatility with the company, and there's a pretty big jump up going from around $74.50 per share up to almost $80 per share. And this is when the news of Elliott Management was released. And the reason behind this is Elliott is an activist investor, and the market seems to like Elliott Management's odds of being able to boost metrics like earnings per share over time. Now, one of the things we can also see in the Q2 earnings report, Starbucks slashed its full-year revenue growth to low single digits from a prior forecast of around 7 to 10%. Now, that was a pretty big reduction. Again, that's why we saw the big decrease in the share price. And in fact, if we jump over to my profitability spreadsheet, I've already plugged in Starbucks. We can see revenue for the past decade has grown very consistently with the exception of 2020. But now we're actually expecting to see little to no growth. So 2024 revenue will probably be pretty close to what we saw in 2023, close to around $36 billion. Now, what will be interesting to find out is what will this gross profit ratio look like at the end of 2024. For the most part, again, with the exception of 2020, gross profit ratio has been relatively steady over the past decade, a little bit lower over the past couple of years. But like we saw in the earnings report, margins are down quite a bit in the US and also internationally as well for 2024 for the past couple of quarters. So this will definitely impact the bottom lines for the company. And we can see, again, 5-year revenue CAGR, 7.79%, 10-year revenue CAGR, 9.22%. So 2024 will be a radically different year from a revenue growth perspective. Now, if we jump over to our stock screener, let's come up here, plug in SBUX. And there's a couple of things that I want to point out, mainly shares outstanding and return on invested capital. We can see shares outstanding has declined quite a bit over the past decade, so yes, they are paying out dividends, but share buybacks historically have been a pretty big deal for the company. We can see they've gone from around 1.5 billion all the way down to around 1.14 billion. Now, over the past few years, they haven't been buying back nearly as many shares, but overall, pretty considerable share buybacks during this time. But here's why I think Starbucks is still a somewhat quality company. Yes, they are a little bit susceptible to the overall wellness of the market. As we've seen, the consumer is a little bit weaker right now, so we are seeing less transactions at the actual store. But look at return on invested capital for the past 3 years for this company. 2023 return on invested capital was 27%, 2022 23.7%, and in 2021 nearly 21%. So 3 years in a row, we've seen return on invested capital of over 20%. Now, why is this important? Well, we have to keep in mind, what is return on invested capital? Well, this is basically telling us how profitable are the projects that the company is putting their capital into. And typically, anytime a company has a return on invested capital of over 20%, that's considered really, really good, especially when you can see it over consecutive years. So again, with the exception of 2020, return on invested capital for this company has been pretty much over 20% every single year. That's really, really good. So I think even when the company has more difficult years like 2020 or 2024 this year, if this return on invested capital can remain around 20%, I think long term, Starbucks is still going to be able to deliver pretty solid results for investors. If we start to see declines in this return on invested capital over time with Starbucks, that's when it's probably time to start asking questions. So again, yes, there are good parts and also bad parts to the earnings report. There's less transactions, we're seeing worse margins from the company, but we're also seeing some boosts from the loyalty program and still really good return on invested capital from this company. So with all this being said, is Starbucks a good company to consider buying right now? And we can see the company in the post market now is up 5.58%. So this is radically changing as I speak. But again, let's go ahead and jump over to our valuation spreadsheet to see if we can find the intrinsic value of this company. We'll come up here and plug in SBUX and hit enter. And the data will automatically load in. Now we can see the beta for the company sitting at 0.94, so volatility is pretty close to that of the market. But if we jump into our first valuation, we're gonna get Graham's valuation. Let's go ahead and zoom in a bit. We can see the formula laid out for us here, and I plugged in all the variables right here. We have our estimated earnings per share average from analyst. We have our growth rate projection, which remains relatively high for Starbucks still. And if we go over to Seeking Alpha, we can actually see, if we click on earnings and look at earnings estimates, let's go ahead and scroll down. We can still see, yes, really slow earnings expectations in 2024, but we can see double-digit expectations for pretty much the next decade for Starbucks. So earnings are still expected to grow at a pretty high rate despite the struggles in 2024. So I'm staying in line with analyst expectations of 14. But then we have the current yield on AAA corporate bonds. This is taking into account current market conditions. And right now this is sitting at 5.13, which is pretty high compared to how it's been over the past decade or so. And when we plug all this into our formula, we come to an intrinsic value of $64.84, which is definitely radically smaller than the current share price of the company. Now, the next valuation we're going to look at is going to be our discounted cash flow analysis. And again, basically what I'm doing is I'm predicting how much free cash flow this company is going to be able to produce in the future, which will help me find the intrinsic value. And you can see I'm projecting a growth rate of about 10.5% to the future free cash flows of the company. I then find the present value of those future free cash flows and add them together, add the company's cash and subtract out total debt to get equity value, divide by shares outstanding, and I come to a DCF price per share of right at $82, pretty close to what the company's actually trading at right now. Next, let's look at our multiples valuation. You can see our comparable companies. Basically what we're doing is we're looking at how the market is valuing these comparable companies, looking at their price to earnings multiple, taking the average, and applying that same price to earnings valuation to Starbucks. So we can see with an average PE of 25 for these comparable companies, if we apply this to Starbucks, we'd actually get an intrinsic value of about $90.21 per share. And if we jump over to Seeking Alpha, we can see right now Starbucks price to earnings sitting at about 21.08. And if we look at the valuation, this is actually quite a bit lower than what it has been historically. Look at this, price to earnings non-GAAP for Starbucks, trailing 12 months, right now sitting at 20.66, but their 5-year average is close to 30. So that's around a 30.48% difference. That's pretty large. And then finally, if we look at our last valuation, one of my favorites from a dividend perspective, that's the dividend discount model. And this is a company based on how much they pay out in dividends and how much that dividend is increasing over time. So you can see our historical data right here and our year-over-year dividend increases. Average growth rate over the past few years of around 7.94. And moving forward, I'm projecting a dividend growth rate of 6%. And with a discount rate of 8%, we come to a dividend discount model price per share of $120.84, which is definitely quite a bit higher than that current trading price. So when we jump over to our output tab, we can see when we average all four together, we actually come to an intrinsic value of about $89.47. Now the current price here is showing $76, but that was as of the market close. Again, like I said, this is changing pretty radically in after-hour trading. After-hour trading, they're now up around 5.77%, which is a little over $80 per share. So if we go ahead and plug in 80 right here, just so we can see, it looks like there's around a 10% difference in our intrinsic value and current share price. So with the 10% margin of safety, it looks like our acceptable buy price comes right to around $80 per share, and with a 20% margin of safety, around $71.58. So overall, this earnings report was actually a little bit better than I was expecting from Starbucks, and the market seems to actually like it quite a bit as well. Yes, they did miss on revenue, but there are some key things that I think are looking a little bit better for the company. And when you take into consideration some of the pain that Starbucks is getting right now doesn't necessarily come from their own company, but from the market as a whole. So as for me, I don't necessarily have plans to add some shares of Starbucks to my portfolio as of this moment, but I do have to admit, over the past couple of months, when it was trading as low as around $72, $73, or $74 per share, I did add a couple more shares to my personal portfolio. Keep in mind that starting dividend yield is the highest it's been in over a decade, backed by pretty solid dividend growth as we can see, 10-year, 15%, 5-year, 8.88%. And when I also take into consideration the very good levels of return on invested capital over the past decade, I think there's still some opportunity here. The company still has struggles. Yes, the market as a whole is struggling. The balance sheet doesn't look its best right now, and transactions are down for the company. But long term, I think this company will be fine. The loyalty rewards program has continued to grow and is up over 7%. And if we can see some recovery in the economy as a whole, then I think this thing could climb quite a bit higher. But go ahead and let me know in the comments down below what you think of Starbucks, if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets or get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.